Good morning. This is Connor from 0DTE Traders, and in this video, we'll cover the week ahead, highlighting upcoming events, options expiration, SPX levels, and volatility dynamics. Let's dive in. This week, all eyes are on the Federal Reserve as it announces its second interest rate decision of the year. With a 99% probability of rates being held steady, the focus will shift to the updated dot plot and Powell's press conference. Sentiment has been weighed down by U.S. President Donald Trump's mixed signals on tariffs and trade tensions, dampening growth expectations for the economy. Participants will closely examine the dot plot for insights into the Fed's growth outlook and any remarks from Powell on tariffs. Also on the calendar are retail sales data due out this morning and housing data later in the week. On the earnings front, participants will receive quarterly results from two heavyweights, Nike, the world's largest shoe company, and FedEx, an economic bellwether. To start the week, the Gamma Index, which measures dealer gamma, remains negative at negative 1 billion notional, which has been the prevailing regime for several weeks, indicating that dealers are short gamma and bears are in control. This transition from a destabilizing regime to a stabilizing regime is 5,900. Therefore, a move above would shift dealers long gamma, allowing bulls to regain control. Now, until we reclaim the flip and we see that positive gamma build, the playbook we've been preaching for 0DTE trading, which has been very effective, remains valid. Low risk option structures, utilizing the double zeros, 50s for targets and pins, diversifying risk in both directions, book profits at 2 times premium, 100% ROI to take risk off the table and enter risk-free trades. Utilize structures to identify trend changes and use these as entry indicators, and look for setups at key times near the open, 9:30, 11 o'clock, 1:30, 2 p.m. We tend to see pivots around those times. Late last week, SPX bounced off the 5,500 put wall, which is known as our lower bound, staged a 2% rally, breaking this multi-week downsloping structure, the first indication of a trend change. We are now looking for a break of 5650 for a higher high to confirm a potential trend change for a move into 5700, gap zone from 5705, 5770, followed by 5800, 5810, and another gap 5812 to 5842, followed by 5850, 5860 resistance. There are also two other downsloping structures to note, one connecting the all-time high. That's one test, two test, three test at some point, as well as another downsloping structure connecting the high from February 24th, one test, two test, three test, and fourth test at some point. Now, we don't necessarily know when these are going to come into play because that depends on time and velocity. Nonetheless, we should mark these off. They could act as resistance, whereas a break would be a bullish indication. Now, absent a break of 5650, we are largely stuck in a trading range. So that's 5650 on the upside, 5500 on the downside. And the mean of range is more or less 5565, which is the JP Morgan put strike. Also entry into a downside gap from 5566 to 5521. Now, if we do break 5,500, which is currently our put wall, that would be viewed as a continuation indication to the downside. That would be an outside week and could get fairly ugly. So I would say three sort of scenarios to watch for: break of 5650, possible trend continuation, range-bound trading, which was the dominant action here last week, a lot of whipsaw, or a break of 5,500 as a downside continuation indication. Although we saw volatility crush last week, which was a supportive variable, the ongoing uncertainty surrounding growth and tariffs makes a full volatility reset unlikely in the short term. We expect a new lower bound to form, likely around the VIX 20 handle. We continue to monitor the VIX closely. These are our levels, looking for peaks and troughs. And obviously, being below the flip and negative gamma, volatility is an exacerbating factor. Also on the radar here this week is the upcoming option expiration on Friday. As of now, it is a negative gamma-weighted cycle. This simply means that the puts holds much more value than the calls. However, if you look at the open interest, there are more calls expiring than puts. But the point is here that when you go into option expiration, option pricing becomes highly sensitive, and subsequently dealer hedging. Dealers are very active hedging these positions, which we believe should keep realized volatility high this week, even if we do reclaim the flip. Now, as we mentioned, the flip is 5,900, but given this sensitivity into option expiration here, we very well could see the shift move substantially lower in coming days, which would be a bullish indication. Now, post option expiration will remove around 30 to 40% of S&P Gamma open interest. So this is generally known as the unpinning, which will essentially require less demand or supply to push the market higher or lower. Now, oftentimes, although negative gamma cycles are rare, they are often associated with lows in the markets. Now, this is a pretty low sample size, but this has played out over the past couple years. I think in short here, the market is still in a destabilizing regime. We've seen some improvement here, possibly a tradable bounce, but we're really looking at key levels and upcoming catalysts to see if this rally has legs, or are we going to continue to see these pops get sold into? Time will tell. Anyways, that's all I have for you guys. If you're not a member and you're interested in learning more, you can visit our website at 0DTEtraders.com. Best of luck out there this week.